I think as the Senior Parliamentary Secretary, Mr. Eric Chua, quite aptly put, capital flows to where it has confidence. And the theme for this panel is how this certainty, transparency, can give that confidence and help the market to scale. How do we create the best possible infrastructure for the market? How do we open the aperture for the broad swath of carbon projects to find financing, to be bankable, to be investable? Oi-Yee, can we start with you? I think you came from a traditional finance background. You moved into intangibles, digital assets, and then you moved to carbon. What are the lessons to learn? What are the parallels that we can draw from your experience?
Thanks, Randall. Very good to be here. I come from different perspectives. So, I run a carbon credit exchange, Climate Impact X. I was a banker for many, many years. And actually, lastly, but actually quite importantly, because we sponsored this, I'm the co-chair of the carbon workstream for the Singapore Sustainable Finance Association. And so when we sort of unpacked this problem, it really came out of the concept that SSFA was trying to build around, which was how do we build the ecosystem for carbon project financing? And as we sort of talked to the bankers and we put together a focus group, and one of the key issues was around the bankability. Obviously, the key issue following that is, what is a carbon credit? How do we, what's the legal title? How do we deal with it? And then how does the financial system treat it, right? Or use it as a bankable, investable asset? And this is sort of somewhat, I think, inspired the teams to sort of come together to put this paper together. But then when I look back on that as a banker lens, and I thought, oh, we kind of took this for granted, right? Because in the traditional financial service world, when you talk about securities or you talk about bonds, you kind of take the legal infrastructure very much for granted. But we also forget that it's, I think, centuries or a century of evolution or decades of revolution. I was just joking with Randall earlier. Electronic stock exchanges didn't exist, well, they existed for about maybe 50 years. And so a lot of that has evolved over time. And yet carbon is a very, very young concept. It's a very new concept. And so we're actually right at the beginning of that. So trying to put together the traditional lenses of the financial and the financial asset onto carbon is something that we're on the beginning of the journey of. And I think we will learn along the way. There are many things sort of put together by the team here that are very relevant. And so, as SSFA supporting the good work here of GenZero and One Partnership and PwC, we're very grateful to have this partnership to continue the dialogue and continue to evolve together with the ecosystem.
Let me just pick up on that, Rachel. So Oi-Yee said that maybe we take things for granted. In traditional finance, you have a complex system of rules, you have regulations, you have definitions, and legal protections to sort of manage the multi-party, multi-jurisdictional nature of the relationship. Is there a benefit, you think, to applying this same discipline to carbon?
I think, as Oi-Yee mentioned, we are at the early stage of development of carbon credits, and personally, I feel that we should find commercial ways to generate this interest and the volume and the tradability before we put the legal framework on it. Of course, as Oi-Yee mentioned, we prepared and launched a paper last month, talk about the how carbon credit should be looked at from the legal perspective, but I think it's good to let it grow a little bit from all these multilateral discussions. Having said that, a word that I've been hearing for the past week and the past few months about carbon credit is the concept of standardization. So, because the laws of different countries are different and there's so many different organizations, no one has come up with a set of rules or a basis for us to all operate on the same basis. So I think personally, to answer your question, I don't think we should regulate it like a share, like an offer of security, but we should let the commercial world grow a little bit more before we put these hard laws on it. Yeah.
So what I hear you saying is that we should apply some discipline, but not too much, because you don't want to hinder the market to grow.
Exactly.
So assuming that you have some level of certainty, some level of harmonization today, what is the immediate benefit that you see?
I think it's harmonization. I think some international organizations like UNIDROIT and many other organizations are trying to harmonize. The benefit is that the world, every country, we will start to believe in the same fiction. You know, we have leading authors that say that in today's world, we create fictions for ourselves. A company is a fiction, because when you look at a company, we all know that what a company should look like and should behave. When we talk about a share, we know what a share is, whether you're in Europe, America, or Asia. So if we can harmonize it and commonly across the world believe in this fiction of what a carbon credit is, and when you see it and you know it, I think that's when, you know, carbon credit can grow.
Can I turn to you, Eu-Lin? I mean,
sure.
Let's all believe in Harry Potter together.
Harry Potter.
Hogwarts.
Okay, nice.
On accounting disclosures,
Yep.
what could we do better?
Okay, so firstly, I think, really, big thanks to GenZero and collaborators for inviting us today. When, I got invited to do this panel on legal and accounting nature of carbon credits, I asked myself, will the room be filled up? Because it's actually quite a dry topic, right? But this is amazing, this is such a full room today. Just to give a little bit of background, I was an accountant, a chartered accountant by training, went into financial services, focused, and then now in sustainability and climate change. Randall, you asked what is it that can be improved in relation to accounting for carbon credits. I would say that a couple of things. The first thing or comment that I would make is that I think we need to work with what we have. So if you look into the accounting standards, I'll just touch on the International Financial Reporting Standards. Mika is going to talk maybe about the latest news from the FASB, right, which is from the US standard. It has been built on many, many years of deliberation, and you'll find that in accounting standards, like in law as well, which has layers and layers of experience over the years, right, is that we have certain standards. We have standards for inventory, we have standards for fixed assets, we have standards for financial instruments. But we don't have a standard for carbon credits, right? However, the good people of the ISCA, Institute of Singapore Chartered Accountants here in Singapore, for example, came up with the Financial Reporting Bulletin 11, which says that let's work with what we have in terms of the principles of accounting, whether it's inventory, whether or not it's intangible assets, right? That's IS 32, and say, okay, how do we classify carbon credits? Is it an asset, right? Should it be expense? Is it inventory? So, if you have some free time over the weekend, do read the paper, the Accounting and Legal Nature paper that we have, and also, the FRB 11 as well. I think it makes for very, very interesting read. Then, we also have the IFRS 2. I think many in the room here understand IFRS 2, which is the climate standard from the IFRS Foundation. And it's, I think it was, to accountants, it's really intuitive, because you read it and you say, okay, a lot of the accounting principles are within there itself. But I just want to say, again, working with what we have, what does IFRS 2 say? So the first thing that it says is, can you identify the risk and opportunities, whatever it is, anything that's sustainability related? And that includes carbon credits as well. And then also is that, can you actually share a little bit more about the current and anticipated effects? So, putting a number to it, right? And of course, the other area, which is a catch-all, which is, what is decision useful information? So we talk a lot about financing, right, the carbon projects, right? What is important, what is decision useful information for investors, for financiers, for you to also put out there, right? So answering your question, Randall, should we actually have a separate standard for carbon credits? Should we be surprised that we don't have a separate standard for carbon credits? I say I'm not surprised, because I think, was it Rachel who said, it is quite a new area, and we also have the principles that we can say we make do with what we have. But maybe in the future, when this, and I hope, right, in a Harry Potter future, that we have a lot more of this, maybe it deserves its own standards. So I think that's one thing that I would say. Oh, no, sorry, the second thing as well is that working with what we have, the more we work together, lawyers and accountants, financing people as well, carbon credit people as well, to say what is decision useful information that can allow for the flow of capital into great projects, I think the better, in the absence of a standalone standard. Yeah.
So what I hear you saying is maybe, but not yet. But
well, we can have to push for it if we believe in it.
But definitely, sometime in the future, it's something to consider.
If the markets are big enough, for sure, it would deserve its own standard.
And Mika, just following on from that, you also have strong opinions about the way that we should think about carbon credits on the balance sheet, as assets, as liabilities. Can you tell us more about your work?
Yes, thanks. So I had come from the Securities and Exchange Commission in the US working on climate disclosures. So the points that you're making about decision useful information for investors really resonates. Without decision useful information, corporate decision making is incomplete and investors can't allocate capital efficiently. I co-founded an initiative with Thomas Neeg, who's in the audience, called the Climate Liabilities and Assets Initiative. And the premise behind it is that climate is already creating liabilities. They're here. It's regulatory commitments, it's reputational risks, it's lawsuits, assets that are threatened by physical changes. And whether we're accounting for them this way or not, these are the things that are motivating companies to engage with climate actions to try to balance in some way those liabilities. So that can take the form of a variety of environmental attribute credits, carbon credits, and direct actions to try to reduce their emissions. But right now, we're not seeing this conversation show up in the financial statements. And that means a few things. One, it means that these decisions are not maybe being subject to the same discipline and rigor of capital allocation within companies. It means that investors don't have the information to understand the real value at risk for companies, and then on the other hand, how much they are taking steps right now and setting themselves up in the future to manage those risks. And so from the Securities and Exchange Commission's perspective, we were trying to aim to improve those disclosures. That process, unfortunately, got stalled with the change in administration. And just yesterday, the US Accounting Standards Board published their final standard for environmental attribute credits. And the points that my panelists made about letting more innovation and experimentation proceed before putting a standard in place really resonates, because we have a counterexample of where a standard is now in place, and I think it will have some serious unintended consequences. So what the US Accounting Standards Board essentially just said is that while you can treat compliance credits, so credits you intend to use as part of a compliance system, or credits that you intend to sell, you can treat those as assets. But any credit that you're purchasing with the intention to use it, whether that's today, in 2 years, or in 10 years, you must expense it, and you must expense it immediately upon purchase. So this intention-based standard puts companies in a really difficult position of needing to take basically a profit and loss penalty for engaging in climate action, and reflects a policy decision by the Standards Board that credits are throwing your money away, that there is not an economic benefit there. But we know and have heard over the last couple of days that we see in the billions of dollars that are committed that actually companies do see an economic benefit here. And asset treatment enables them to subject those decisions to the rigor of capital allocation planning within the company, and it provides investors with an ability to understand whether companies are stewarding their money effectively. So not only does it not reflect, I think, the economic value underlying these assets, but I think it's actually shortchanging investors with information to be able to understand the return on those investments. And I also think from a practical perspective, this will make engaging with carbon credits quite a bit more challenging for US companies. And now we have this unhelpful divergence. So to your point about harmonization, the US, once again, creates some tension there that will need to be resolved. So yeah, I mean, many more thoughts on the benefits of asset treatment, but this is the state of play from U.S. accounting perspectives right now.
So where I hear the challenge is mainly with the voluntary carbon credits because that's expensed. If you have compliance credits, that's maybe held as an asset. If you have your voluntary credits held for trading, that's also an asset because it's an inventory. But when you want to use it for, say, decarbonization goals, that's where you have the issue.
That's right.
Eu-Lin, we know that the US has sometimes different accounting standards. I won't say it's different accounting standards, but they use GAAP, we use IFRS. Is there anything that you have to comment on that also?
I think that just in respect of, we've always had differences, but not a lot of differences, right, between US GAAP and also IFRS. We've lived with it. So many of us will either interact with large groups which have presence in the US or presence elsewhere, which use IFRS or equivalent of IFRS. And we work with that as well. There's a reconciliation. So that's how I view things as well, that if there continue to be differences, it's not insurmountable, and I suppose that we have to reconcile that when it comes to financial reporting. I recognize, the behaviors that could ensue, if there were, we follow such a different kind of certain type of accounting outcomes as well. But I think, for me, I think it always goes back to first principles. What does the so-called asset look like? Does it have the attributes, of an asset? And this is where I think the lawyers in the room are very, very important, because one of the key things, right, that the legal nature is important is whether or not you own the asset and you can control it. So let's see where this goes, and let's wait to see. And I understand that from an IFRS perspective, the carbon credits accounting papers is on the reserve list, so let's hope that it inches higher as well in the future. But let's see. Yeah.
Rachel, just to pick up on Eu-Lin's point about, she's throwing it back to the lawyers, right? So
Yes.
why is it important? What is the important thing that the lawyers have to do in order for the accountants to say, then I can do my work? What is the legal nature is one thing. Why is legal nature? Maybe some people here, it's preaching to the converted, but just to round it up for the audience, why is it important that we say legal nature needs to be certain? Why do we need to have certainty around transfer? Is there any issues relating to, like, say, custody security? What's the nub of the issue?
Yeah. I think before I go to that, I want to raise a provocative answer back to Eu-Lin. Actually, usually when the companies prepare financial statements, they will very often, the auditors will look at the contracts first, and also the circumstances surrounding the contracts and so on. In this case, isn't it a little bit, isn't the accounting standards a bit front-running the contracts and the nature of it? Because they are putting accounting standards on carbon credits based on intention of the company in this case, which can be quite arbitrary. In my view, I think they should wait a little to see how this type of instrument or entity evolve before putting a standard on it, because it just adds to the confusion. Yeah. Anyway, back to Randall's question. I think we're speaking to a room presumably of many lawyers, so I think we all believe that it's important to clarify the nature of carbon credits. As a backdrop, for those who are new to this topic, there are two main schools of thought. One is that carbon credits are just a bundle of contractual rights, and the other school of thought that it could be treated as a form of intangible property. So in the paper that we launched with GenZero and PwC Singapore, supported by SSFA, we are putting forward the position that we should collectively, and the law supports the position that carbon credits can be a form of intangible property, and it is important. Imagine that you have bought something, let's say one of our SME bosses had bought a JTC factory and is told that he gets 60-year leasehold interest. And he suddenly finds that all this money that he's paid is just a bunch of contractual rights. So I think it's important to establish when someone buys this instrument or this security or this whatever it is, what is at the basic level what is the nature of this instrument? Yeah, I know sometimes from regulators or even, I don't know about bankers, but if it's popular or if they want to regulate, they may not need to delve into the nature of it, but I think to us lawyers, it is table stake, it is very basic. And fast forward, I think when the developers or the bankers have a project and they document it and they bring it to the risk department, both the lawyers and the risk people will ask, what instrument is this? So I think it is important for us to support this position or try to align the position, whichever the case may be. And for us, for the co-writers, we believe that we should try to support, and we believe, and we've done research on our common law and Singapore law that is well supported to be a form of intangible property.
And then just to draw that out a little bit more, I suppose the point is that even if you don't have certainty over what it is, what are you taking as security, for instance, as a financier? What is your priority in insolvency? As between a buyer, as between a financier, as between the last person to help to hold the credits, as between the insolvent company, I suppose that's also a question, right?
Exactly.
Then let me throw this question to Oi-Yee from the perspective of an exchange, right? What would you like to see in the market? You've heard the disclosure portion, you've heard the legal portion. What do you want to see as a banker and a practitioner?
I think at the end of the day, I mean, not just an exchange, but actually the whole carbon ecosystem and the carbon markets for the true mobility of capital. And this is actually why we're here, spending the last few days talking about all these things, right? It's not just about the carbon credit and the legal nature. It actually is about what is the mobility of capital to projects, to carbon projects. What is the mobility of capital from developed nations to developing nations? What's the mobility of capital into the right projects to help us achieve our Paris Agreement targets, which I think we're somewhat agreeing that we're not going to get there. But we need to do it, right? We need all these efforts, and we need trillions of dollars of capital to make this work, to make carbon markets work. And the problem today is that it's still a very fragmented market. It's a fragmented market for many, many reasons. We have a lack of demand signal. We have a lack of financing into the various projects. And I think everything we're trying to do to solve here is to allow for a deep, liquid, transparent carbon markets. And it's not just about the voluntary carbon markets, right? It is voluntary carbon markets are now one of some mechanisms. The projects, underlying projects are the same, but it's the voluntary carbon markets, it's the compliance markets, it's the CORSIA markets. How does Article 6 come into play? How does 6.2 and 6.4 come into play? And as we think about deploying capital to grow those projects, to fulfill these needs, again, not just at the voluntary level, but at a much broader global level, how do we then think about the mobility of capital? That's where we start to come up with some of these, like, sort of, oh, we're going to trip over this, we're going to trip over that. And so while we talk about how early the work is, it's actually quite instrumental to create the standardization and the harmonization that we need to scale. And I think if the bankers out there are still struggling with mechanisms to say, well, can we even finance a RED Plus project, or can we even finance biochar? The question mark on the underlying instrument is questionable. Then I think we're all having problems by trying to reach certain targets in 2030 or 2050. And so as an exchange, obviously, one of the biggest things we think about is all of the above, right? Liquidity, transparency, fungibility, bankability. At the end of the day, it takes a carbon credit, which is right now as a simplistic use of buy to retire. So maybe an expense should be what is just classified as. But if you think about long term and why corporates should be thinking about mitigation, why corporates should be thinking deeper about the mitigation strategies across their decarbonization pathways, and how governments should be thinking about Article 6.4, I think then that gives a very different lens as to why we're having this conversation and why we need to move from step A to step B, and the legal nature, we kind of agree and harmonize can then give the confidence for bankers to make these or bank these projects, and then ultimately for exchanges to create a liquid pathway for all of these, not just for buy to retire, but again, there could be trading opportunities. We're starting to see that in the COSIA market in a little way. So we're very, very hopeful that, that we see very clear pathways for carbon credits to be really a fungible and a tradable product.
Mika, we talked about, or you talked about how certain movements or certain regulatory movements, let's say interpretation of carbon credits, in a sense, is unhelpful for the market. Could you maybe, let me throw the reverse question at you. What is an instance of a regulatory movement that you would like to see that would be helpful to the market?
Thanks, yes, and I think we are seeing in other jurisdictions regulatory moves that are enormously helpful. So to take a step back, I think bringing an asset lens to carbon credits can be incredibly useful, particularly as jurisdictions consider the linkages between voluntary carbon markets and compliance markets. And what I mean by that is that right now, one of the challenges of bringing nature-based credits into the perimeter of compliance systems is that the credit as sort of a one-time thing that's expensed leaves people very uneasy. There's risk of reversal, there are permanence questions that make it not exactly on par with compliance allowances or even other kinds of carbon removals that are more certain, more permanent. But if you take an asset lens, you can actually think about managing that risk over a longer time period and keeping accountability for that particular carbon avoidance or removal. And by that I mean that one could have sort of a useful life of that credit. You could think about impairing it if there's complete or partial reversal. You can also think about maintenance efforts and things that would actually extend the life of that asset. That might not be something that individual companies are well positioned to handle, but you do see jurisdictions like in the UK and in the EU thinking about how the government might actually be able to create pools that manage some of those risks and then enable companies to be able to engage with those pools in a way that puts them on more equal footing with other kinds of carbon credits. And that kind of asset treatment, I mean, sort of my capital markets brain spins out and thinks about how you could apply various financial wrappers that would enable other participants in the markets to engage in a way that they're not able to, where you have complex OTC transactions with expensive due diligence. And so, you know, if you think about what would be useful from a regulatory perspective, I think it is leading by example to show how you can account for carbon credits in this way. The leadership of setting up structures that demonstrate how you can bring nature-based credits more into the fold. And then I think providing support to corporations to be able to engage with these assets in ways that is lower risk, lower transaction costs.
Eu-Lin, how do you feel about that? Taking the risk or supposedly liabilities relating to permanence, relating to the long tail of the actual effect of a carbon credit and putting it on the books for everyone to see, whether it's a government or whether it's private institutions. How do you think about, how should we be thinking about that at all?
Again, you know, like I said before, I think we want to work with what we have, you know, all the first principles that we have available or made available to us. And when you talk about that in terms of permanence, or let's say that you know, the project itself, you know, suffers a little bit of issues, right? So let's say a fire of some sort. So you know, when I want to make one point later, but I'm just going to answer your question first, right? So if you recognize it as inventory, which is really around if you are you know, a producer, right, of carbon credits. Under IFRS, or the principles of IFRS, you recognize it as inventory, and let's say something happens, right? Permanence is affected, and so on. So you take the principles of the inventory standard, which is IAS 2, and you say whether or not, you know, the net realizable value, you of your inventory, is it recoverable? If it's not, you take the hit down on that. Then the other one is that if you are, holding, right, carbon credits, right, for your own use, that's an intangible asset, then you have to see, actually you have to test it every year for impairment. And, if for that, right, the recoverable value again, if it's not to whatever you recognize in the books, then you have to take that hit again. So that's the technical answer to it. But as I was like, when all these I guess our panelists were talking, right, and I was just thinking about accounting. Actually, there's a ledger that doesn't exist within the balance sheet or the P&L that is also there that we have to take note of, which is the ledger of greenhouse gas emissions, right? So for that, of course, the standard that governs that, or the target setting standard that governs that is the SBTI. And the other one as well is the GHG protocol. Both of them are undergoing through review. They have already released out a semblance of what they are focusing on or they want to put out. I think that's something as well, that over and above, making sure that the legal and accounting nature is tight for the purposes of the balance sheet and the P&L. Whether or not we have certain reconciliation differences, that's the other one that we need to take note of as well, that will allow the carbon credit markets to flourish. Yeah.
Thank you. I think we have a little bit of time, so I'm going to go to Q&A. And this is a question for, I think, everyone. In terms of timelines, right? If you're thinking short-term versus long-term, what are, in your opinion, the quick wins, and what do you think is a long-term systemic change that is needed? So what is the short-term and what's the long-term things that you look forward to? Mika, maybe let me start with you.
Great. Well, I think that the kinds of concept notes and papers that I've seen come out, from GenZero and from others that help to show a pathway for treatment and give some certainty, and the work, I think, of auditors too, in putting out guidance that can be used as financial statement preparers are thinking about what to do from a short-term perspective, that is enormously helpful. I think from a longer-term perspective, to get to that demand piece, which is essential, deepening these linkages between voluntary markets and compliance markets, and then showing how you can create pathways for capital to flow to projects that then can satisfy those requirements, I think long-term will be really essential to really drive a lot of capital. And then along the way, making sure that the legal and accounting standards are supporting that investment and making sure that there isn't a penalty for companies that are actually trying to make themselves more resilient, more sustainable, and balance those climate liabilities that they have.
Maybe let me jump. Rachel.
Yeah, okay, all right. Short run, I guess Singapore is part of ASEAN. I think if we can't get the whole world to align, perhaps we could try to get ASEAN to be aligned. I'm a Singapore rep to the ASEAN Business Advisory Council, and for a very long time we tried to connect all the 10, 11 nations digitally on financial systems, but we were unable to. So what did we do? We now are connected to Thailand, and we try to bring Malaysia and the others on board. So on carbon credits, actually, a country like Indonesia, they are very, very interested. So perhaps we could start with some bilateral, they have credits and we are a trading hub. Maybe we could work on a bilateral basis and start to get other ASEAN countries involved. And then ASEAN alone can create its own market. I think that would be a quick win. Yeah.
Oi-Yee.
I think for the short win, actually not so much about legal nature or accounting treatment. It's a bit more around corporates and the voluntary space. Because compliance, at the end of the day, if the government wants you to buy, you have to buy, right? So you don't have to think about that so much. But in the voluntary space, one of the things that we're working very hard on is also how do we create demand signals. And at Singapore Sustainable Finance Association, we're working very closely with the Coalition to Grow Carbon Markets. How do we create an implementation guide for corporates to follow? And these are largely for corporates who are right now, well, those who are buying, right? They're committed, they know what to do, they're buying. There's a group of corporates who will say, this is rubbish. They will never buy, right, whatever you do. There's a group in the middle that have to buy and want to buy, and they're afraid to buy. So how do we create these short-term incentives, or to at least create air cover? So I think in the short term, having some kind of a regulatory sort of overlay or some kind of an air cover for companies to buy, who buy responsibly, I think would be a short win, because that then sends demand signals. And that then send demand signals, then yet financiers, equity, debt financiers, much more comfortable, much more confident. And when that starts to scale, then there will be a quicker evolution of everything that we're discussing today. And in the longer run, I think this will drive, the people would then, professionals will then come together to make sure that the market becomes more harmonized so that it continues to scale.
Thank you. Eu-Lin?
Well, I'll firstly say that I think that we should learn from the past as well and make sure that we take those lessons and we apply it for the future. And with that, just continuing on from what Oi-Yee had said as well, which is that the Singapore government had also quite a number of months ago, sent out some guidance as well in terms of responsible usage, of carbon credits, right, from the corporate world. Right? I think that's very, very helpful, and I do hope that the ecosystem will continue to build on that as well in the future. I would say the second point that I would make is just how is it that we can be brave enough, right, to be able to make choices in our own jurisdictions as well. I'll give you an example. The Science Based Target Initiative has very, very high standards. Why? Because it's called the Science Based Target Initiative. It's based on science. It is about how do I get to a 1.5 degree pathway, with a decarbonization pathway, right? They have to be very high standards. But the world is not monolithic, it's not homogeneous. They have developing countries, developed countries, countries like Singapore as well, who are very, very land scarce. Energy resilience is very important to us as well, and security is very important to us. Some standards will come out and say that, I'll just give an example. No, we won't be able to recognize, say, for example, renewable energy certificates against your Scope 2 unless, the electrons are delivered to you. It's very difficult for countries like Singapore. But I think that if this was to exist as well, so not something which is not tailored for different jurisdictions, it will not allow for the flourishing from a demand side nor supply side as well. So I would say that learning from the past with more deliberation, but also with the right guardrails, are we brave enough to make certain tweaks for us to unlock? Yeah.
So what I hear you saying is that it's not just about frameworks that form the backbone of the carbon market. It's a whole of market effort. Everybody needs to chip in. And we need to look to harmonization. We need to look to the relationships that we have, not just as corporates, but also between states. That kind of cooperation is necessary for market scale. And what you're saying, Eu-Lin, is that it's more important to also be practical rather than to be ideological about where we move, because 1.5 may or may not be within that reach to us now.
Yeah, we've got to be practical, but I mean, if our markets are based on trust and transparency, so if required trust isn't required, then let's put in those safeguards as well, additional safeguards. Yeah.
And I think with that, I have only to thank the panelists. I don't think we have much time left. Thank you very much for the discussion and for challenging each other.